Hello, my name is Fritz Nauk. I'm a co-leader of McKinsey's global insurance practice. We're very excited today to share perspectives on a wide range of topics. We've assembled a diverse group of colleagues from around the world. Today, my colleagues will highlight the insights across 6 themes that shape the insurance industry agenda for 2023. These include life insurance, property casualty, health insurance, distribution, analytics, and leadership. Thank you.
Hello, my name is Ramnath Balasubramanian. I'm a senior partner and I lead a North America life and retirement practice. I'll spend the next few minutes sharing our perspectives on the future of the life insurance industry. The industry, as you all know, plays a critical role in meeting the protection, savings, and retirement needs of society and shaping long-term economic development through its role as a long-term investor. Now, the industry is facing a number of irresistible forces at this point of time. Coming out of the pandemic, there's a growing awareness of the need for protection, both in terms of life insurance as well as health insurance, as well as an increasing need for a broader retirement and social security net. Just to put it in context, the number of people above the age of 65 globally is expected to double over the next 30 years to almost 1.7 billion, with Asia driving over 67% of this increase. A lot of these needs is going to be met by the private sector, given the significant funding gap that a number of public social security and pension systems actually facing. Interest rates are obviously an important factor shaping the performance of the industry. As we all know, the last few decades have seen an era of ultra-low interest rates as central banks have followed a quantitative easing policy. Over the last few months, there's been a significant increase in rates as central banks have looked to bring inflation under control. Our view is that these near-term elevated nominal rates will lead to a tailwind for the life insurance sector, particularly as asset rotations happen quicker than liability adjustments. But over time, we will also see an increase in ROE expectations and the overall hurdle rates, which investors will have for the industry, which will neutralize these effects in the medium to long term. Consumers' expectations are increasing as they're shaped by the experiences across their day-to-day lives, with an increasing demand for better, more integrated digital solutions. The industry has historically lagged in meeting the technological needs of consumers. However, over the last 2 or 3 years, in particular, with the rapid emergence and growth of new technologies, in particular applied artificial intelligence, cloud-based solutions, create opportunities for the industry to tackle some of the historical challenges they have faced from a technology perspective. And then finally, the role of Asia remains extremely important and will continue to shape the future of the industry going forward, particularly with the large middle-class opportunity which we see in the emerging Asia markets in China, India, and Southeast Asia. Nearly 1.2 billion consumers in these geographies by 2030. While there are several forces shaping the context of the industry is at a crossroads today. The performance on a macro basis has been disappointing, with significant variability and a number of different structural shifts underway. Growth has been below GDP for a large part of the last 2 decades. In fact, nominal GDP growth has actually outpaced life insurance growth by 2 to 3 times across geography, US, Europe, as well as Asia. Furthermore, the industry has struggled to actually meet its cost of capital expectations. This is an example of what we've seen in terms of industry performance over the last 2 decades. What the lines indicate, the blue line indicate that years in which the industry has delivered return on equity over and above the cost of equity, which are investor expectations. And the red lines indicate where they delivered below cost of equity. And as you can see, for a large part of the last 2 decades across geography, the industry has underperformed in meeting its expectations to investors. The other context to keep in mind is that while the overall performance has been disappointing, there are a number of structural shifts which we see are underway in the industry. two shifts in particular, which are highly pertinent and relevant, which will shape the future of the industry, is really one around the role of private capital, particularly as the life insurance industry declines in relevance in the broader public markets. As a data point, the share of life insurance to total financial services market capitalization in the United States has fallen from over 20% of the overall financial services in the late 80s and the early 90s to less than 5% today. So public market investors are questioning the relevance of the life insurance industry. The gap, though, has been met by private capital, both in terms of institutional investors, alternative asset managers, as well as mutuals being an important construct. Furthermore, in addition to the role of private capital, there's also an important shift underway across geographies, North America, Europe, as well as Asia, in terms of the role of third-party independent distribution, evolving away from historically an industry which has been reliant on more tied captive distribution. A combination of these factors indicate that there will be a significant need to evolve the business models of the industry going forward. Our perspective is that in the future, the life insurers will need to move from a model where they are doing all activities across the value chain, across a number of different products, to a model which is more simplified, focused, and unbundled, where they focus on a few activities where they can be truly distinctive and make choices around products and segments where they can be competitive in. And for other activities, they rely on partnerships or leave it to others who are more distinctive in those parts of the value chain. We see a few different models emerging in terms of how insurers can pursue value creation pathways. And let me just describe to you 4 examples of these models. The first is what we would call a distribution specialist. These institutions will have privileged access to distribution, deep consumer insights and understanding of customer needs and how to meet those expectations, and typically will invest significantly in client-facing technology to make for a superior experience for consumers. These companies will typically not manufacture products on their own, but distribute products from other third-party insurance companies, and in so many ways, focus on providing consumer choice through a true open architecture approach. The second model is what we call the product manufacturing and origination specialists. For these companies, they will also have privileged distribution access. It could be through own tight distribution, or it could be through deep relationships with third-party distributors. They will have a deep understanding of the customers and strong ability and capabilities to assess risk, underwrite, and manufacture products. However, these companies will typically rely on others for investment and asset management capabilities, as well as in many cases, providing balance sheet capacity and balance sheet strength. And so these companies in many ways will focus on the front end of the business system, which is product manufacturing and distribution, but leave the asset management and balance sheet to others whom they partner with very closely. The third model is the balance sheet specialist, which is in many ways the complement of the product origination specialist. In these situations, these institutions will typically not have very strong direct distribution capabilities on the retail side. However, in partnership with other insurers, primarily product origination specialists and distribution specialists, they will offer very strong investment management capabilities and bring to bear a highly rated balance sheet and a number of institutional partnerships. And then finally, there will be a handful of life insurers who will continue to be what we would call a fully integrated life insurer who perform activities across the value chain. But even for these insurers, they will need to make some very clear choices in terms of which products and segments do they take a wholly integrated approach, and for what other products do they actually take a more unbundled approach. Our view is that by pursuing this business model transformation, life insurers will be able to create value for their customers as well as their shareholders and continue to improve their relevance in the broader industry context. Thank you.
Hello, everyone. My name is Cyrus Ramazani. I'm a senior partner based in Switzerland. And I thank you for being here for this short session where I will try to provide a brief overview of the P&C industry. When we look at the global P&C market, we recognize that it has shown remarkable resilience over the past years. And that includes its performance during the largest pandemic of our lifetime. Over the past 5 years, the global P&C industry has grown by 5% annually. It's actually an acceleration in historic growth, and it's in sharp contrast to what we've seen in the life insurance sector, as we've just heard. This growth has been very well balanced across different regions, with the Americas being slightly ahead of Europe and APAC. At first glance, this is a pretty exciting picture. However, when we look a bit closer, we discover that across many segments of the P&C market, growth has actually lagged behind GDP quite significantly. And this is particularly true for the personal line segments. In commercial lines, on the other hand, we've seen growth rates at face value that well exceed GDP growth. Yet even there, if you consider the massive rate changes, increases in commercial insurance in recent years, the picture starts to look quite a bit different. After correcting for this effect of rate change, commercial insurance is actually losing significant ground. In our minds, this raises a pretty fundamental question. Is the P&C industry at large running a risk of gradually losing its relevance? We strongly feel that it's now the time to discuss 4 specific challenges the industry is facing, which are somehow masked by the currently strong performance, both in terms of top and bottom line. While in commercial insurance, the P&C industry is benefiting from pricing tailwinds in the core business, the industry's overall response to the challenges posed by climate change, cyber, the future of mobility is, let me call it, work in progress. In addition, there are growing headaches around rising claims inflation, as well as growing price sensitivity amongst those parts of the population who will be most affected by the anticipated possible economic downturn. The real fundamental challenge for the P&C industry is how to secure and potentially expand its relevance for customers and society at large. The second challenge is related to the customer interface. I think we're all aware brokers have captured an overproportional share of the value in recent times. Today, it's the insurtechs, which are innovating how insurance is delivered to the customer. And then there is, plenty of new entrants like retailers, telcos, OEMs, who are packaging insurance as just one puzzle piece into their propositions and customer journeys. Is the P&C industry running the risk of losing the battle for the customer interface? Question mark. Then when we look at industries such as consumer electronics, telcos, car manufacturers, who are reducing their unit cost year by year. For them, it's kind of like a way of living. In P&C, on the other hand, cost has been on the agenda of virtually every P&C insurer, but operational efficiencies are often offset by increases in technology cost. As a result, the reductions in expense ratios over the last 5 years are largely explained by rate rises rather than material productivity improvements. So how can the P&C industry overcome this productivity lock? And last but not least, in line with the rest of the economy, P&C must come up with an answer for what their employee value proposition will look like post-COVID. This includes making hybrid working models work, but not only that, the P&C industry is also facing an increasing level of competition for analytics and quantitative talent. With these challenges in mind, we see 8 imperatives that we encourage executives in the P&C space around the globe to think about. First one being climate and ESG. Taking your own organization to net zero is a great start, but the P&C industry shouldn't really punch below its weight. So the question here being, how can ESG become part of the core underwriting business? How can the industry play a more vital role in the biggest capital reallocation in the history of humankind? And what are the propositions, the capabilities, but also the risk appetite required to do so? Beyond ESG and climate, we argue that it's now the time to innovate. The many systemic risks that various societies, economies are facing don't always fit with the traditional risk appetite of P&C carriers. But coming back to the point from the beginning, in order to sustain its relevance in the long run, the P&C sector needs to innovate and find solutions for these new types of risks. Customers are expecting innovation, especially around business interruption, cyber, where coverage has been either very insufficient or prohibitively expensive. Furthermore, we need to develop innovative solutions that help manage the risk, not just transfer it. This is being increasingly explored in the personal line space, where services such as route suggestions and motor insurance or weather warnings and home insurance are helping customers anticipate and reduce their risks. Thirdly, in addition to meaningful customer engagement and creating compelling customer experiences, it's critical to invest now in these areas if the P&C industry doesn't want to lose this field to others. And in the instances where the P&C insurer, based on the business model, is not fully in charge of the customer interface, the industry will have to partner with others, nimbly, at scale, but with a clear role and value proposition vis-a-vis both the partner as well as the customer. Then fifth, we argue that P&C still needs to unleash the full potential of data and analytics. If you think about it, traditionally, the P&C industry was thriving on the notion of having more data than its customers. In a way, that has been the foundation of the P&C business model for centuries. This is changing today very rapidly. We need to invest to preserve our edge when it comes to using data to drive risk insights, mitigation, pricing strategies. Coming back to productivity, the industry needs to address the productivity challenge head on with an even more aggressive ambition level. This will involve embracing technology as a core discipline and modernizing, upgrading platforms as well as the internal capabilities. And lastly, despite of all the possibilities arising from technology and automation, the P&C industry will continue to depend on high caliber talents across the entire value chain. Thus, it's essential for P&C companies to develop and implement effective strategies to attract, develop, and retain the right talents for the future. Now, our sense is, going through this list, that most industry participants would broadly agree with the importance of these imperatives. When we shift to the discussion, what does it take to actually, act on them, the discussion becomes a little bit harder. And we feel there are some underlying drivers of inertia that the industry needs to overcome to unlock its full potential. Let me go through these. The one thing that we increasingly sense is a somewhat sobering realization around the lack of global scale economies. And, we see that also in parts where players basically are rationalizing their portfolio and giving up on plans to really, find these synergies across the large dispersed portfolio geographies. On the other hand, successful players are shifting their inorganic efforts to consolidating their largest domestic market positions, which offer ample and tangible value creation opportunities. Secondly, many players in the P&C market suffer from broad, historically grown business models that span across all products, customer segments, and channels. This complexity very often becomes a hurdle to acting on the imperatives we spoke about earlier. On the flip side, when we look at players with more focused business models, they often achieve real competitive advantage in their respective area. Then it's very interesting when you look at the insurance industry and the dividend yields. The insurance industry really has become, especially in North America and in Europe, a leader when it comes to cash generation for shareholders. The dividend yields of insurance companies now even exceeding that of utility companies who have held that top spot for many decades. Yet, there's also a little bit of word of caution because changing the productivity DNA of an insurance company will require investments. And we feel that being honest and realistic about the scale and the timelines that some of these investments entail is absolutely crucial. And lastly, the industry is enjoying healthy growth rates and on average delivering stellar returns to its investors. So it's actually a good time. Yes, this often comes at a somewhat muted risk appetite and low level of innovation with regard to some of the next frontier risks and challenges that our world is facing. We would argue that now is the time to explore new models and ways to tackle these challenges and therefore secure the P&C industry's role in society for the next century. Thanks a lot for your attention. With that, I would like to conclude a short overview of the P&C sector and hand over to my colleague Ulrike, who will speak about the health space.
Thank you very much. My name is Ulrike Dätjen. I'm a partner based in Germany and lead our health ecosystem work. A buzzword many years ago, but I think today ecosystems have really transcended from hype to reality. And they're really changing the role of insurers from the pure risk mitigation to really shaping the health ecosystem. But let's take a step back to the big picture. Healthcare is actually not where it should be. So poor health really takes its toll on life expectancy and quality, on productivity, and also on our economy. The research of our McKinsey Health Institute, our global think tank for the big needle-moving questions in the world's public health space, shows that a lot is actually known and has to be scaled, and the potential is huge. $12 trillion by 2040 of GDP impact could be reached through tapping into the full potential of preventative measures and new treatments. and not only in the medical setting, but really also in everyday life. However, the everyday life or the everyday reality of patients still looks very different. Imagine you have a health problem. You're looking for help online. There's a wide array of sources. You decide to ask for medical help and then need to talk to a specialist. Then actually it's a very cumbersome process to look for the right individual. And then you have to repeat all the things that you already looked for again. And that complexity really gets multiplied once you transcend the online-offline care continuum. So once you enter the traditional care system. But now let's close our eyes for a second and imagine the world of an integrated, tech-enabled health ecosystem. Consumers are using tools in their everyday lives within and outside of the medical care setting, tools that really third parties can develop and plug into a platform that takes care of all the tedious processes. So single sign-on, identity management, authentication, authorization, to make journeys in the health ecosystem really seamless and as convenient as people are used to from other industries. And that creates a lot of value because ecosystems are all about win-win-win situations. For providers, as they provide care beyond the confines of the medical system, for pharma, as they can show that their medication also works in the real world, and most importantly also for insurers, as they can bring together activity data and outcomes data. So who used that service, and then did this person actually go to hospital afterwards? And going forward, they can also ensure that payments actually flow to those things that really improve lives and show benefits in the data. And this really changes the role of insurers, as you can see on the next slide. And I argue that insurers can really play a central role here because they're well positioned based on the data that they already have and the benefits that they create that way. And that really changes the role of the insurers from an insurance-centric value proposition based on protection and prevention to a much more customer-centric perspective in which prevention and different services and steering into the right care setting are an integral part of an insurance offering. And these help to create value in many different ways. So first of all, to win new customers. Secondly, to select the right customers, because those that are actually interested in healthcare and health offerings are also more attracted by these offerings. That can increase loyalty as they appreciate the service levels. And finally, there's value in steering people in the health setting, in the health system into the right care setting, and with that, of course, having an impact on claims. However, this also places requirements on insurers along the value chain. Maybe most importantly, technology. It's what makes the difference for how convenient a journey is for consumers. It's what makes the difference whether it takes a project or a click to integrate a new partner, and what makes the difference also for new future aspirational uses of data in the future of care. And it also places many new capabilities along the classic insurance value chain. So services from broad lifestyle offerings, where people are potentially rewarded for healthy habits, to a range of care services like telemedicine, for example. These can often be provided to partners, but then that also requires new capabilities in the partner management. And it also requires new capabilities in the very classic insurance areas, also in distribution, as will be the focus of the next section led by Bernard.
Thank you, Ulrike. You heard the growth challenges in life and P&C, the innovation and transformation challenge. So where's distribution in all of this? We would like to call out 4 forces that we see as critical for the future of distribution to unlock these growth potentials and these innovation potentials. The first one is what we call personalized advice. And in essence, it means moving a product push model towards really a customer-led and customer needs-based model. We recently did research, and 70 to 80% of customers want real advice, want needs-based understanding of their situation. However, the same customers say 3 out of 4 moments feel like push selling from agents or brokers. So personalization is key, and it means around packaging the right content in the right moment for the right customer. The second theme is digital hybrid. At the moment, we still see channels very much in silos, a digital channel, a broker channel, an agency channel, often even in tension with each other. However, the future is a digital hybrid engagement where we expect about 70% of touch points being online, being digital, but the customer wants the critical intervention points to be face-to-face. He wants the personal relationship with an advisor when it really matters. The great positive about digital hybrid engagement is that for an insurer, you can multiply your engagement points because actually, as Ulrike laid out for health, you can see the real opportunity along the full journey and not just in a moment of a claim or a sale. The third theme is around customer acquisition. And there we see it as critical to innovate how you actually acquire customers at scale. And that will require new forms of digital partnerships because the usual relationship-driven model in agency or bank distribution is not enough. So insurers will need to plug into digital partnerships much more. And lastly, to provide that holistic advice, you really need to shift from single products to more holistic solutions and be a connected insurer that can plug in multiple offerings and also cut across industry boundaries. Let me share a few examples on each of those four topics. On personalization, I mentioned the shift from being a product push to being really customer and needs-based. How does this really work? Ideally, you find the right triggers, as you see here in the little visual. These triggers can be moments in life. These triggers can be news that are out there and change the situation that customers think about it. And then it's about what is the right content. And the right content is not just an insurance offering, but it's much more around how you actually provide curated information. Customers want to understand. Customers want to be in charge. And then lastly, you need to find the right channel of communication. So this is not about distribution channels, but this is about how you actually connect with your customers at the right time. The second theme is digital hybrid. And here the example for agency and what it really takes. It really requires that you amplify the ability to have digital acquisition through the agents, that you empower them to do that. Then it requires a seamless journey across your channels. It requires, as I mentioned, still the personalized advice when it matters, but personalized advice can be face-to-face in an office or in a coffee shop, but it can also be through video. It needs really AI-led field management that equips the leaders with the information needed to connect the different dots and channels. It needs, as we will speak later, modularized propositions. It needs the underlying data. It needs a different way of managing the channel, and it needs a lot of technology. So all that needs to come together to create that digital hybrid experience that then allows you to fully unleash the potential across all your channels and make a sum that is greater than its parts. Customer acquisition, and how would that work? This is a complex chart, and we deliberately kept it complex because that is not easy. And what we really say here is it's about the right selection of the leads and then building the right awareness and consideration through much more curated content. You see here the themes: education, retirement planning, wealth and investments, health and wellness, international. All this allows you to engage along the needs and not immediately jump to your insurance product. And then it needs that engagement through multiple means. And through this, you can acquire customers at scale and at much lower marginal cost. Finally, the connected insurer. At the moment, what we see is that most agents sell a few specialties they have. A few companies even focus on a few specialties. I'm from Asia. Here, some companies focus entirely on critical illness or whole life propositions. But what customers really want is this connection. They want partners that help them serve their needs holistically, maybe also understand the trade-offs between those needs. And this is what we mean with connected insurer, so that channels are able to really offer services and solutions across a range of themes. Putting all this together is a challenge, but the growth opportunity is huge. You heard that insurance has globally underperformed nominal GDP, and it's time to change this through innovating distribution. And I also mentioned that analytics is at the core of distribution, same as it is for all the lines of business. And therefore, let's dig into this, and I hand over to my colleague, Violet.
My name is Violet. I'm a partner based in Shanghai, leading our digital analytics for financial services in Asia. And today I'm here to talk about analytics and AI in insurance. What we're experiencing in the past 10 years in terms of growth availability of data is much greater than the amount of cumulative data since mankind history. So this is really phenomenal. And this exponential growth in data and also the falling cost of data storage and also the processing is enabling a lot of innovation in insurance business models. In fact, in one of our recent research, it shows that AI technology could potentially deliver up to 1.1 trillion of additional value. So this is quite significant. And if we take a look at the different stages of maturity of where insurers are at in terms of leveraging analytics and AI, the first stage is where I think most of the insurers are at. And this is where, insurers are getting used to having the ability of having integrated data, predictive models are being leveraged, right? AI is starting to be a function, but it's not yet at scale nor embedded in the business. The second stage is where the center of excellence is created. AI use cases is being used and leveraged at most, if not all the functions. The third stage is where automation and also AI insights are driving most of the decisions. So this is actually becoming more like a platform of decisions. And the fourth stage, which is the final stage, is where the organization has really leveraged AI as its core of DNA and all silos are integrated. And as mentioned, insurers are starting to capture value from analytics and AI, but most are at stage one. And many have yet been able to deploy at scale. So what are some of the issues that insurers are facing as they're adopting AI? We're seeing that, for example, only 17% of the CXOs have mentioned that they have defined and sustainable analytics roadmap in place. Most have mentioned that they have some sort of roadmap in place, but they're mostly in silos. Only 13% have stated that they have been able to fully integrate analytics insights into all their business processes. So I think what we're seeing is some of these typical struggles spanning from unclear value capture, a lot of silos in the organization, poor data quality, lack of at-scale talent, and also the capability as an organization to execute this at the speed and at the scale required. Having said that, we're also seeing many insurers are starting to generate major impact of AI across insurance value chains. So if we take distribution as an example, we're seeing leading insurers are actually using AI leads and customer value management across omni-channels to really improve that the GWP growth, as Bernard mentioned in his section on personalization. That's a very finite and great example of where analytics is starting to create value at scale. Another example is underwriting and pricing. This is having the state-of-the-art pricing models to improve the probability and also be able to improve the customer experience along with that. And for claims management, this is about reducing claims costs by a holistic AI-enabled transformation of core processes. And some of these processes include cash management, straight-through processing, and fraud detection. So if we're putting all these together, for insurers of the future, really leveraging analytics and AI at its best, we're seeing a few building blocks across 4 areas. And I'll synthesize this for each of the areas. On reimagining the engagement layer, this is really about how do we leverage analytics and AI so that the modular proposition are tailored to individuals and having that omni experience that's personalized at scale and really leveraging the zero ops conversational user experience, predictive customer experience to build a differentiating experience. And the second area is around AI-powered decisioning layer. This is the engine behind this, right? So how do we leverage the power of behavioral science, the ability to drive proactive engagement, using advanced analytics to simplify, automate, and enhance making accuracy across value chain. The third layer is around the infrastructure, so the core tech and data, right? How do we define an end-state modernized tech architecture that's flexible, adaptable, and also scalable to be able to have close to real-time decisioning power? Last but not least, we heard about siloless in this transformation. So operating model is very, very important. So how do we make sure we set up the organization so that it enables for faster decision-making and better decision-making and also agility? Okay. So if we're to put all these success factors together, we're essentially synthesizing into a few recommendations. Taking a top-down commitment is extremely important and be extremely rigorous on prioritization for impact. Also taking a zero-based approach on the reinvention of functions and really taking a cross-functional team approach in driving this. Be ruthless and relentless in understanding and measuring the value creation. This is very important in terms of transformation. And having an organization and capability ready to fail fast and ready to scale. Last but not least, having the absolute transparency on impact and building organization capability towards that is super critical. To close on this, leadership and how the power of top management and the thinking around this is super, super important. So I'm going to pass it on to my colleague, Quilleen, to talk about leadership.
Thank you, Violet. Wonderful. I want to talk about not just leadership, but the specific role of the CEO and the amount of value that CEOs across insurance carriers can drive is incredible. If you look across the industry, over 2/3 of CEOs admitted they were not ready for the role. At the same time, about 60% of CEOs live up to expectations in the first year, but about 30% of Fortune 500 CEOs last actually less than 3 years. So as we go on decade by decade, CEO tenures are shortening and shortening, while the incremental impact and value that CEOs drives is increasing. About half of CEOs actually said, this role is not at all what I expected, even though I've been training for it for a long time. So CEOs have a disproportionate impact. In fact, CEOs today are 2 times more predictive of the company's overall performance financially than they were 50 years ago. There is 30 times more economic value driven by the top quintile of CEOs than the next 3 quintiles combined. And collectively, the top 2,000 CEOs actually employ 70 million people. So the scale and potential impact across employees is significant as well. And if you look at the excess value that's created from the top 200 alone, highest performing CEOs, that's the difference of $5 trillion in impact compared to peers. That's the equivalent of the 3rd largest economy in the entire world. So getting the CEO role right has significant impact across employees, across economic value, and disproportionate impact driven. So what is it that great CEOs do? We did some very quantitative research across the best CEOs in the world. We looked historically at the 1,000 largest companies in the world, and we looked at their CEOs this century. And then we applied a number of filters. We said, let's look at the CEOs who have been a CEO for at least 6 years, right? We want them to be longer than the 3 years or less that 30% of the CEOs actually last. We want them to be able to live with a lot of their management decisions. So 6 years or more. We looked at those who outperformed others in terms of shareholder value. So kind of top 2 quintiles, excess total returns to shareholders compares to peers in the same industry. So compared to other insurance carriers, for example. And then we added reputational and social, ethical, environmental screens for a number of companies. And we did a diversity screen as well. And overall, that got us to about a list of about 1,000. And we invited about 80 of those CEOs to do a 2 to 3 hour interview with us. And from that distilled, what is the operating model of the most effective CEOs in the world? What do they do differently than others? And if you look at this next page, it boils down to 6 core things. And let's explore each of those 6 things, starting with setting the direction. And setting the direction is all around being bold. It's around allocating resources differently. The next piece is around engaging the board, helping the board of directors help the organization in the right way, making sure you have the right people in the role. Then there's this piece of connecting with stakeholders, and that's both customers, employees, others, starting with the why your company exists and what you do. The fourth piece is something that the best CEOs do incredibly well, which is manage their personal effectiveness, their energy, their focus, doing really things that only the CEO can do. The other piece is mobilizing through leaders, solving for the team's psychology and the dynamics across the leadership team so that their entire team can be much more productive and effective with each other. And finally, the sixth thing is aligning the organization, what we call treating the soft stuff as the hard stuff, right? The people, the culture, the support, and the connectivity across. And those are the 6 things that CEOs do, especially particularly effective CEOs do much better than others. But even the most effective CEOs don't do all 6 of these equally well. And so I think the question for CEOs is, which are you relatively good at, right? Which of these buckets are quite full? And which of these do you want to work on, right? At this moment, this week, this month, what might you need to focus on a little bit more? Is it deepening relationships with the board, being more transparent? Is it setting a bolder and clearer direction and vision for the organization? And so looking holistically across those 6 areas is what CEOs do best. A couple of examples across each of these 6 areas. In terms of being bold, right, setting a clear vision, reframing the game, and making big moves in your strategy, dramatic resource allocation over time, even acting like an outsider. A couple examples are Ajay Banga at MasterCard shifted their vision from beating Visa to how do we kill cash? And that strategic focus shifted how the organization spent time, how they allocated investment, how they allocated talent quite significantly across the organization. At Lego, Jørgen Nunstrup actually shifted from little plastic blocks to licensed collections, to entertainment, to clothing, to education, created a much bolder, broader vision for the organization that inspired groups and new service lines and lines of business. An example on engaging the board, interestingly, about 80% of executives thinks at least one of their board members should be replaced. And only 30% of executives report that their board processes are very effective. And so in that environment, how do you improve the effectiveness of your board, the composition, the combination of skills? Larry Gulp at GE actually said, when in doubt, share, right? This sort of inclination towards greater transparency with your board of directors and deepening those relationships. Jamie Dimon at JP Morgan said, start with a private session with each board member and a very personal, since we last met, here's what's happened. And so building those relationships, prepping individual board members before meetings, increasing transparency are all key there. On connecting with shareholders and really starting with the why, almost 90% of at least United States customers say their decision to purchase a product is strongly impacted by the issues that a company supports. So how transparent you are, what you support really does matter. 30% of corporate earnings, as we look across and control for different factors, are actually influenced by the company's relationships with external stakeholders. So these relationships with external stakeholders really matter. And so social purpose, impacting the bigger picture, all of these things are big drivers of total returns to shareholders. Doug Baker, for example, at Ecolab said, don't do evil during the day, and then from 6 to 7 p.m. at night, do good to try to offset anything else you might have done during the day. Or Mary Barra at General Motors talked a lot about navigating the ignition switch recall with transparency and by doing the right thing, and that was really a pivotal point in building a transparent and trust-based relationship with stakeholders. On the last 3 elements of CEO effectiveness, managing your personal effectiveness and doing what only the CEO role can do, 90% of CEOs struggle with work-life balance, and that's unfortunately not a huge surprise. And roughly 2/3 struggle to manage the role overall, even beyond the work-life balance piece. We've seen this century a 30% decrease or shortening of the tenure of a CEO from 10 years to 7 years on average. A couple of examples of how to do this well, right? Managing your personal effectiveness, managing your energy. Michael Fisher at CCHMC said, don't have a to-do list only. Actually live your to-be list. What do you want to be? How do you want to role model? How do you want to live? The 5th element of mobilizing through leaders and solving for the team psychology is reflective that the number one factor that investors look for is the effectiveness of the top team. And when you survey top executives, over half of them don't feel like their top team is performing. And when you go into HR, it's even worse. Only 6% of top HR executives actually believe their executive team is a well-integrated, well-functioning team. And so how do we change that and allow the team to be at their best and performing at the highest levels possible? Lars Sorensen at Novo Nordisk would say, this is all about creating the conditions for B players to become A players, right? That's the difference that this can make. And finally, on aligning the organization and treating the hard stuff as the soft stuff. Actually, over 70% of barriers to implementation are due to the soft things, right? The people elements, the cultural elements of change. And only 1 in 3 strategies are actually successful in driving impact and sustaining that impact. And so in terms of culture, what we've seen of effective CEOs and effective organizations is focusing on one thing and doing it really well, right? One consistent theme. Satya Nadella at Microsoft would say it's all about the growth mindset in each of our roles, in each of our ways, in each of our businesses. Others focus on organizational design and both stability and agility. And others focus really hard on talent and putting people first and effectiveness of talent, rotations of talent and development over time. And so those 6 things in conjunction, and again, no CEO, no leader really can do all 6 extremely well. It's about picking your strengths, building on your strengths, and then making sure that the weaknesses aren't too low and that you're focusing on them from time to time as well. I'll wrap up by saying there's a number of stories and leadership quotes from the 67 CEOs in the CEO Excellence book. But a couple of my favorites, one of my favorites was really, you're better than you think, right? Take the step, have more confidence in your abilities and be a bit more bold. This focus on being bold, inspirational, setting a vision, reallocating resources in a different way than would have happened through inertia. And the final quote here is, don't just wait to be a CEO, right? For every senior leader across the executive team, there may be a desire to be a CEO, but don't wait for that. And so whenever somebody asks me for advice or asks, how do I become a CEO? I say, don't wait for your next job to do your best work. And I think that's inspiration for us all to think about those 6 different dimensions and how we can be more effective at each of them. Bernhard, over to you.
Thank you very much. The Great Reset is the title of this Global Insurance Forum, and we hope the tour d'horizon across 6 themes has given you a feel of what is coming and what is the agenda for this Great Reset. In closing, we would like to first and foremost highlight the important role insurance does for our society. And this bigger purpose is something that you heard across all presentations, and it's really important. To deliver on that purpose and also to deliver on value growth, it is a complex, it is a broad agenda, and you felt this probably over the last 40 minutes. It needs bold change, it needs innovation, it needs new capabilities and a new technology. And as we heard from Kwai-Lin in the end, it needs strong leadership. And with that strong leadership, we would like to thank you all for this session. And we wish you all a very successful conference. Thank you.
Thank you, Bernard. That was extremely informative and so poignant in the current environment where CEOs are leading through extremely challenging times. I hope you enjoyed the session as much as I did, and that you will stay tuned for the next 3 days to hear more from our star-studded roster of industry leaders.